Hi, welcome and thank you for joining us today for our webinar on the new Secure Act 2.0. I'm Lisette Smith. I'm a senior advisor here at the advisory group working with our personal wealth clients.
And I'm Margaret Hiller, and I'm a senior advisor also at the advisory group, and I work with our personal wealth and our institutional clients. We have a lot to cover today, so therefore we may not be able to answer questions as we go. So please go ahead and put your questions in the chat box, and we will reach out to you after the webinar.
Oops. Oh, sorry. Okay.
All
Sorry,
right,
Marta.
no problem. Okay, so today we're going to be talking about the significant retirement-related legislation that was signed into law on December 29th, which was called Secure 2.0. So this was a component of a bigger spending bill that was called the Consolidated Appropriations Act of 2022. The Secure 2.0 portion alone was more than 350 pages long and had more than 90 new retirement-related provisions that impact employer-sponsored plans and also individual retirement investors. So one important note before we start going through some of these provisions is regarding effective dates. So there was quite a range of effective dates in this bill, some that took effect immediately or took effect this year, and others that won't go into effect for several years in the future. So for purposes of this presentation, whenever we talk about the effective date for an employer-sponsored plan, we're going to assume that we're talking about calendar year plans. So if your plan is something other than a calendar year, your effective dates might be different from what we say. But it's otherwise too much of a mouthful to keep saying the first plan year that begins after December 31st of such and such a year, et cetera. The effective dates for the provisions that impact individuals are much more straightforward and clear. So with that disclaimer, we will go ahead and get started.
So one of the biggest changes for individuals in Secure 2.0 is that you now have a little more time to let your tax-deferred retirement accounts grow before you're required to take a minimum distribution. So the original Secure Act in 2019 changed the RMD, the required minimum distribution, from 70 and a half to 72. But that was pretty short-lived because beginning this year, the age you need to start withdrawing from your IRAs and retirement plans is now going to be 73. It will stay 73 for 10 years until 2033 when it increases to age 75. So basically, if you're born between 1951 and 1959, you'll need to begin your required distributions at age 73. And for those born in 1960 or later, you'll start at age 75. There's a little glitch in this right now for those that are born in the year 1959 because you'll turn 73 while it's age 73, but then you fall out of it for a year and then back in. But you should plan that your RMD age will be 73 because that it will probably have a technical corrections in the next round. The final thing under RMDs is that the act also decreases what used to be really onerous penalties if you failed to take your distribution on time. It had been 50% of the shortfall, and that's now been reduced to 25%. If you correct it in a timely fashion, it's actually only going to be 10% going forward. So that's also of benefit.
Okay, Secure 2.0 also changes the way that retirement plan catch-up contributions will work beginning next year. So the new rule requires that catch-up contributions for those who earn more than $145,000 in the prior year must be made on a Roth basis instead of a pre-tax basis. So the first note here is that if your plan does not currently provide for Roth 401k, and if you have people that are earning more than $145,000, those higher paid employees will not be able to make catch-up contributions next year unless the plan is amended to allow for Roth. So that would be priority one, is to add a Roth provision to your plan. So while this new rule sounds relatively straightforward on the surface, there are a lot of questions to be resolved between now and the end of this year. So first is the fact that the rule references W-2 income, but not self-employment income that's reported on a K-1. It seems hard to believe that they would not have intended to include, high earning self-employed people in this rule. So I think it's likely that there will be a technical correction coming on that particular point. The next issue is relating to systems, payroll systems, record keeping systems, et cetera. There are going to be need to be changes to online enrollment systems to allow people to make separate elections for their base contributions versus catch up, since not all systems work that way currently. There's also going to be a need now to enforce the fact that certain employees cannot make their catch-up contributions on a pre-tax basis. So there's a lot of programming that needs to be done before the end of the year to incorporate this new rule. There's also some complexity behind the scenes with plan administration because there are some contributions that are determined after the fact to be catch-up contributions. For example, if there's a failing compliance test or if you've exceeded another limit. It's very clear if you've gone over the annual dollar limit for 401k that the excess is a catch-up, but there are other situations where you might have a catch-up contribution and those may not be determined until after the end of the year. So it remains to be seen how all of this will work out with the new rule. And we can expect a lot of discussion about these technicalities this year since 2024 is coming up very quickly.
So as Margaret was saying, currently for those 50 or over, you have the ability to make additional contributions to your retirement plans. This is meant to help you kind of catch up if you're underfunded as you're getting closer to retirement. In the new law, there's better news. If you are age 60 to 63, beginning in 2025, in that age range, you'll be able to put away an additional $10,000 or 150% of what the regular catch-up provision is. All catch-up provisions, as Margaret just mentioned, will have to be made to a Roth if you earn over $145,000 a year. So you don't get a current tax deduction for that portion, but since it would be going into a Roth, it'll grow tax deferred and you'll be able to withdraw it in retirement tax-free. So it's still really beneficial for you. So this affects ages 60, 61, 62, 63. But in the year you turn 64, your catch-up provisions are going to go back to just the regular catch-up amounts. There's a little difference for simple plans. Participants in that age range at by year end beginning in 2025 also have their catch-up contributions increase to the greater of $5,000 or 150% of the 2025 amount. Starting in 2024, just for regular IRA catch-up limits is $1,000, and it has been for a while. Those catch-up contributions will be adjusted annually for inflation, just like the base amount of IRA contributions is inflation adjusted. The only difference there is that it's inflation adjusted, but only to a multiple of 100. So, and it's rounded down if it doesn't get to that next 100. So as a result, it might stay at $1,000 for a little bit longer.
Okay, this next one is an interesting one. So Secure 2.0 allows plans to add a provision, which is an optional provision, to allow participants to receive their employer contributions on a Roth after-tax basis. Okay, so right now all employer contributions go in on a pre-tax basis, and this is an optional provision that plans can add where employees can elect to receive their employer contributions on a Roth basis. This rule is technically effective this year for calendar year plans, but we would definitely not advise that any plans add this yet. In fact, there was very little time to do that until some details are worked out. And I should point out that this rule applies to both match and profit sharing contributions, but there are a lot of open questions about it. So for example, how will the tax withholding and the tax reporting work? Record keeping systems, online enrollment systems will need to be updated to provide for this election. It seems very likely that they will come back to clarify something about this provision to say that it only applies for fully vested employer contributions, because you would not tax somebody on a non-vested portion of a contribution. I will also point out, though, that the end result from the participant standpoint would really be no different from a tax perspective than if the participant had elected to receive the employer contribution on a pre-tax basis and then made an election to do an in-plan Roth conversion, which a lot of plans do provide for. We have not generally seen a huge volume of participants electing to do an in-plan Roth conversion, probably because most participants are not looking to increase their current tax liability. So I think there may be some plans, and maybe many plans, that don't want to deal with the complexity of adding this provision, and instead they will say that employees effectively already have this option because the plan allows for in-plan Roth conversion. So anyone who wants their employer contribution to be Roth, they can receive it on a pre-tax basis and then convert it in plan. Of course, the reason that Congress added this provision is because they want to look for ways to accelerate the collection of tax revenue to offset some of the lost revenue in other parts of the bill. So structuring employer contributions to be taxable is an easy way to do that. The bottom line is, don't change anything about your procedures yet. Let's wait and see till some of these how some of these details will shake out. And this one is big news, although it's been a long time in the making. Any 401k plans that are put into place after the date that the bill was signed, so after December 29th, 2022, will be required to have an automatic enrollment provision beginning in 2025. So you get a little bit of notice, but you're required to do it. The automatic enrollment must be at a rate of at least 3% and at most 10%, so you could start at 10. There must also be an automatic escalation for each year up to at least 10% of pay, or at most 15% of pay. So if you want to keep escalating until your participants reach 15%, you can do that. If you are subject to this rule and you don't want to deal with automatic escalation, where you go in every year and bump each person's percentage up by 1, you could set your initial automatic enrollment rate to 10%. There are a few exceptions to this rule, specifically for companies with 10 or fewer employees or businesses that are less than 3 years old. And also, any plan that already had a cash or deferred arrangement, which is also known as a CODA, which is a fancy name for a 401k type deduction. If they had that in place by December 29th, then that plan is also exempt from this rule. But it gets complicated because what about a plan that existed prior to December 29th and had already signed an amendment, let's say in October or November of last year, to add 401k this year, beginning January 1 of 2023. So the 401k deductions weren't starting until January, but the plan already had that provision in before December 29th. Would this plan be required to add auto enrollment and auto escalation? This is not clear, so we'll have to wait for some further guidance. If you know that you're impacted by this rule, you'll need to give some consideration to the additional match cost in your plan when you start having automatic enrollment and auto escalation. Because with these kinds of provisions, the good news is that your participation and your deferral rates go up. The bad news is that your participation and your deferral rates go up, and therefore your match goes up. So you'll just need to plan for that in terms of your cost projections for 2025.
So if you are a small business owner and you don't currently have a retirement in place, well, first of all, you're not alone. Only 25% of small businesses offer a 401k plan right now. So there are new tax credits to try to encourage small companies to set up a plan beginning this year. So to encourage companies with fewer than 50 employees, Secure 2.0 provides a tax credit for 100% of the setup and admin costs for the first 3 years. So for a lot of small employers, this is really a big enticement. It means you could set up a new plan and really not have much cost for the first 3 years. Employers with fewer than 50 employees would receive the full credit. Then there's a phase out if you have between 51 and 100 employees. This is really a big increase from the prior credit, which it also includes a tax credit for your employer matching contributions. So the credit covers 100% of employee matches for the first 2 years of the plan creation, and then 75% in year 3, 50% in year 4, and 25% in year 5, and then not in year 6. The annual maximum credit is $1,000 per participant, but again, that's really significant. The credit doesn't apply to employees who make over $100,000 and annually. And understandably, if you take the credit, you're you're not able to deduct contributions, but the credit is really more valuable. Something just to remember for small business owners is that if you do set up a new plan, the one thing the Act didn't provide for is an exemption from the Roth need for catch-up provisions that we talked about earlier. So you would still have to get that in place by 2024. But overall, this is a really encouraging tax credit for small business owners.
So not to be confused with any of the new plan rules that we just discussed, Secure 2.0 also creates a brand new type of plan that's called a starter 401k plan. And this comes available in 2024. So think of this as something akin to the simple 401k plans and simple IRA programs that have existed for some time. This is a different type of plan with lower annual limits that's designed to make it very easy for employers to implement new 401k programs. So this starter 401k plan, it allows participants to save up to $6,000 per year. So not all the way up to the $22,500 or $30,000 that we have currently. This one is a $6,000 per year limit for the starter 401k. There are no employer contributions required, and in fact, there are no employer contributions permitted. This plan does not require any ADP or top-heavy testing, which has always been an obstacle for small companies to set up plans. And the plan has to have automatic enrollment. So the idea here is that it's very easy to administer, low cost to administer, and very easy for small employers to set up this plan. If you were to put in this type of plan, if you are a small business owner and don't currently have a plan yet, you could start with a starter 401k and then later amend it into a traditional 401k with higher limits and of course all the rules that apply to a traditional 401k. There is going to need to be a technical correction that will come out at some point in the future to align the limits of this starter 401k with the IRA. So you see this $6,000 limit here. The IRA limit is $6,500. Those two were intended to be aligned. The increased IRA limit had not yet come out when they were first drafting Secure 2.0. So those were intended to be aligned, and we are expecting a technical correction there.
Um, this This item is not part of Secure 2.0, but it's kind of related in that it's something that small business owners in California specifically need to be aware of. And it might be a reason, even if you have just a few employees, that you would consider taking advantage of the new tax credits to start a plan now. So the law in California, this has been phasing in over several years, but as of July 1st, 2022, it applies to businesses with 5 or more employees, and it mandates that if you don't offer an employee retirement plan, you have to enroll your employees into Cal Savers. This applies to both for-profit and nonprofit entities. So, and there are strict penalties, $750 per employee if you don't comply. um, by what's more interesting for really small employers is that by December 31st, 2025, this is really going to apply to any business with even one employee. So again, you might want to think about looking at setting up a small plan now to avoid that.
Parents and grandparents will appreciate this new provision, which has to do with 529 college savings accounts. Um, so 529 account owners, which may be parents or grandparents or other relatives, beginning in 2024, will have the ability to roll over unused 529 account balances to a Roth IRA belonging to the beneficiary. So this really helps to address one of the concerns that people have had with 529 accounts, which is what to do if you overfund, if you know, uh, put in lots of money for your child or for your grandchild, and then they either end up not going to college or not using all of the balances. Up until now, your options were fairly limited. You either could transfer that money to another beneficiary, or you could pay a penalty and withdraw the funds, and because they weren't being used for purposes related to college, then you'd be subject to that penalty. So those were not very attractive options for some people. And this really helps to remove that barrier. So now, if you have leftover money, you'll have the ability then to roll that over to your child or grandchild's Roth IRA. There are a few details to be aware of. So the first is that it's a maximum $35,000 rollover. It's a lifetime limit per beneficiary. And the next is that the annual contribution limits apply. This is really treated as a contribution on their behalf. So the Roth IRA contribution for 2023 is $6,500. So it would take 5 or 6 years, depending on what the limits are in future years, to fully roll over that $35,000 if you have that much left over. The next is that, or next important note is that the 529 account has to have been open for at least 15 years before you can take advantage of this provision. And the funds that you roll over must have been in the account for at least 5 years at the time of the rollover. So there are a few things to keep in mind. This is not something you could run out and do tomorrow for if you just opened up a 529 recently and have a child that's not going to use it all. But the key note here is that if you want to have this flexibility, if you're funding a 529 account for a young child currently, or you're thinking about it, you want to be sure to open that account early, even if you are not funding it substantially when they're very young. You want to get that account open and get some money in there to leave open this possibility that you can use this rollover provision in the future.
Okay, and one last thing for small or self-employed people. For a long time, if you were self-employed, you could create and fund a SEP IRA after the end of the year and up to your tax filing deadline, with including extensions. And now Secure 2.0 extends that so that you're able to establish and fund a solo 401k as well with deferrals for the previous year. You can do this up until the due date of your taxes, although you don't get to include extensions for some reason in this case, but you do get to do it in the following year. So this retroactive deferral is available only the first year that you set up the plan. In the future, you'd have to make contributions by December 31st, but it starts now. So if you could still set up a solo 401k and fund it for 2022. In order to do this, all you need is some self-employment income, and it could be in addition to your full-time work. If you just have like a side gig in consulting and you want to put that away on a tax deferred basis. If you have a small business, you can have part-time employees, so people that work less than 1,000 hours a year and still do this, but you can't have any full-time employees other than yourself and your spouse.
All right, sorry about that. Here we have a couple that got some bad news in the mail. So perhaps they owe some money that they weren't prepared to pay. They will be relieved to know that Secure 2.0 has a new emergency distribution provision that plans can choose to make available beginning in 2024. So if the plan chooses to offer this provision, and it's optional, participants can withdraw the lesser of $1,000 or 50% of their vested account balance. This distribution is not subject to a 10% penalty that normally applies to early withdrawals. A participant can only take one of these emergency distributions each year, and the participant has the ability to repay that distribution within 3 years. But do note that when you take one distribution, you're not able to take another one for the next 3 years unless you either repay the distribution that you took initially or have additional contributions that exceed the amount that was withdrawn. So you can tap into your account for an emergency distribution once, but this is not something you can do every year unless you are putting the money back in.
And in addition to emergency distributions, there's a provision for qualified disaster distributions. And this is a provision in the new law that is actually retroactive for federally declared emergencies since January 26, 2021. And it provides for tax favorable distributions if you are in a federally declared disaster area. So the distribution would generally have to be made within 6 months after the first day of the disaster or the date of its declaration. And a qualified disaster recovery distribution is up to $22,000. So that would not be subject to the 10% early distribution penalty or mandatory 20% withholding on eligible rollover distributions. And then, unless you choose otherwise, you could include this distribution as income over a 3-year period instead of all at once. You're able to recontribute that amount to an eligible retirement plan within 3 years of it being distributed to you. The act also makes permanent increases the limits on plan loans made to people during the first 6 months of a qualified disaster. So that increases to $100,000, or you're up to your entire interest in your plan. It allows you to also extend by a year. It allows the plan to allow you to extend by 1 year the due date for loan payments that would otherwise be due during the disaster period. And plans can also be free to disregard the disaster period plus 6 months in determining the 5-year limit on loan repayments. So all of this should provide some timely relief if you're affected by a disaster, and it provides some additional time and penalty-free funds for those affected by disasters. Um, this next piece is also not part of the Secure Act, but it's something to be aware of. So, in speaking of disasters, in light of the flooding and the storm damage that we sustained here in California recently, there are 49 counties in California that were hardest hit by the storms, including all of the 9 Bay Area counties. The Our tax filing deadline is extended to May 15th, 2023, to file both federal and California returns, both business and personal filings. The designation is automatic, so you don't need to fill out any extra form. And it really included all filing deadlines from January 8th through mid-May. So it includes quarterly estimated tax payments that would normally be due during that period. Um, the deadlines for contributions that are linked to tax filing deadlines, so contributions for IRAs and health savings account contributions, are also extended.
Okay, next we have a laundry list of miscellaneous provisions that we will go through quickly. This is not an exhaustive list, but if something catches your attention and you'd like to learn more, contact us and we can explain in more detail. So first, the Department of Labor is charged with the task of developing an online lost and found tool for missing plan participants by the end of 2024. So if you're a plan sponsor and you have lost participants in your plan, you would register them in this database and they would be able to search and find their balances from old employers. Next, the cash out limit is increasing to $7,000, up from what was $5,000. And it's been $5,000 for quite some time. So this is a big help to the long overdue increase to increase that up to $7,000. Here's one that may not be welcome news, which is that paper statements are going to be required to be delivered once per year unless a participant affirmatively elects to have electronic delivery. These days, plans are really pushing paperless delivery of statements, but in some cases, they're defaulting people to that rather than asking them to make the choice. And so the Department of Labor wants to be sure that people are really getting their statements. And so they're going to require 1 paper statement per year unless the person has made an affirmative election to get it electronically. Beginning this year in 2023, there are certain notices that are not going to be required to be sent to to eligible participants who are not actively participating. So these are things like the summary annual report, blackout notices, if there's a plan conversion going on. In the past, you've had to mail those notices to everybody who is eligible, and going forward, you will not need to do that if they don't have a balance in the plan. However, the plan requires instead, the new rule requires instead that the plan annually notify people and remind them every year that they're eligible to enroll in the plan. So if you have a number of non-participators, going forward, you will need to remind them once per year that they are eligible for the 401k plan or other type of plan, and here's how to sign up. And lastly, last bullet here, this was interesting, and we'll see what people choose to do with it. There is now a provision that allows you to utilize small financial incentives. So these are things like giveaways, like gift cards or door prizes. In the past, there's a rule that's called the contingent benefit rule that says that you can't make anything contingent, any type of benefit contingent on 401k participation except for an employer match. So you could never give away a gift card for signing up, for example. But now the new rule here is saying that you can use small financial incentives. Small is not defined, so you'll have to use your best judgment on that. Do keep in mind, though, that gift cards and that type of thing are taxable. So if you gave somebody a $20 Amazon gift card, you would need to report that as income to them.
Just a few more miscellaneous items. For those of you who use your required minimum distribution to fund your charitable giving, so using a qualified charitable distribution, the $100,000 limit on QCDs has been around since 2006 is now going to be indexed for inflation annually beginning next year, beginning in 2024. The age to use a qualified charitable distribution remains at 70 and a half. It hasn't increased with the RMD age, even though originally it was linked to that age. So we've seen more clients use this since you can't deduct charitable contributions as readily. And this makes the distribution not included in income, which can be even better for keeping your adjusted gross income low for Social Security and Medicare surcharges. So effective, separate from QCDs, effective immediately in the event that an individual requires a hardship distribution from their plan, the plan can rely on an employee's self-certification of that need. And this includes a new hardship provision for victims of domestic violence. Also effective in 2026, the Secure Act allows retirement account owners to take penalty-free qualified long-term care distributions of the lesser of 10% of their vested balance or $2,500 to pay for long-term care insurance. And that, it's not that high of a limit, but it can be used for the account owner or their spouse, and it may end up being extended to other family members in the future. And this can be helpful to pay long-term care premiums, which can become excessive if they increase as you're aging. And the last item, emergency savings account, really hopefully will encourage more people to participate in their retirement plans. It's meant for people who want to contribute to their retirement plan, but they don't feel they can afford to because they don't have enough to have an emergency fund that's set up outside of the plan. So this applies only to employees who are not highly compensated, not defined as highly compensated, and it allows contributions of up to $2,500 for emergencies in an account that's linked to an employee retirement plan. So this allows you to take advantage of employer matching funds in a way that wouldn't be available if you were just trying to build savings outside of your retirement plan. And this portion of your savings has to be kept in a cash account, so it's available for emergencies. But it is a good way to encourage people to use their retirement plan without worrying about having more readily available funds for an emergency.
All of these changes, to the extent that they impact employer-sponsored plans, will ultimately require that the plans be amended. So these amendments must be incorporated into your plan documents by the end of 2025 for calendar year plans. In the meantime, plans should be keeping documentation of their decisions. In other words, which optional provisions they've decided to incorporate and which ones they have not. There should be board approval of changes that are being implemented. We encourage you to speak with us if you have any questions about specific provisions, or if there are any that are of particular interest or concern to you. And we'll certainly also keep you apprised as there's more guidance about some of these open questions that we've discussed. If you have questions about things that we've gone over in this session and haven't already done so, please be sure to go ahead and put those into the chat box, and we will respond to you after the webinar.
There is one question in the chat box that we might be able to answer. It's just clarifying that if you do give a gift card, for example, as an incentive, you only have to report it as income to employees if it's over a certain threshold amount. Is that $20, $25?
I'm not aware of any, I'm not a tax expert for that purpose, but I'm not aware of any de minimis exception.
Okay. We could feel free to reach out and contact us directly with any questions. I know we covered a lot. It is a really broad new law, and there's a lot that's still being worked through and determined how to best apply it. Margaret and I really want to thank you for joining us today. We we appreciate your time. We look forward to seeing you next time, and we'll talk to you soon. Thank you.